What if I told you that becoming a real estate investor doesn't require millions, a real estate license, or a trust fund? In fact, more than 52% of Americans believe real estate is the best long-term investment, yet less than 10% actually own rental property. Why? Because most people don't know where to start. Today, I'm breaking down exactly how to begin building wealth through real estate, step by step, starting with just 0,000, or even less. Let's cut through the noise. Real estate isn't just about flipping houses on TV. It's a proven wealth-building engine. Over the past 40 years, the S&P 500 has averaged about 10% annual returns. Solid. But here's the catch. It's entirely price-dependent. When stocks go down, your net worth drops overnight. Real estate, it compounds differently. Between 1994 and 2024, the average U.S. home appreciated from $30,000 to 0,000. That's a 6.2% annual return, not including rental income. And rental income is where the magic happens. A 0,000 house renting for $500 a month generates 0,000 a year. After expenses and mortgage, you're still pocketing 0,000 to 0,000 in cash flow. Plus, you get tax benefits, forced appreciation through mortgage paydown, and inflation hedging. While your neighbor stresses over stock swings, you're collecting checks every month. The best part? You don't need to be rich. You need strategy. And we're starting right now with the foundation, your financial readiness. You wouldn't drive a car without knowing how the brakes work. Same with real estate. Let's talk numbers. First, your credit score. Aim for 720 plus. Why? Because that's the threshold where you qualify for the best interest rates. A 3.5% rate on a 0,000 loan saves you over 0,000 in interest versus a 5.5% rate over 30 years. Second, your debt-to-income ratio. Lenders want it under 43%. That means if you make 0,000 a month, your total monthly debt payments, car, student loans, credit cards, and mortgage can't exceed 40. Third, your down payment. For a primary residence, you can put down 3.5% with an FHA loan. But for rental properties, lenders typically require 15 to 25%. Want to start with less? Consider house hacking. Buy a duplex, live in one unit, rent the other. Your tenant covers 50% of your mortgage. That's exactly how my friend Sarah built her first portfolio in Ohio, starting with $5,000 and a 20% down payment on a 0,000 property. She now owns 7 units, all financed using cash flow from the first. There's no one-size-fits-all in real estate. Your strategy shapes everything. Let's break down the 4 most beginner-friendly paths. First, buy and hold rentals. This is the bread and butter. You buy a property, rent it out, and build equity over time. A 3-bedroom home in Indianapolis might cost $20,000, rent for $800, and net 0,000/month cash flow after expenses. Second, house hacking. As mentioned, live in one unit, rent the others. FHA financing allows 3.5% down, and your tenants help pay your mortgage. Third, real estate crowdfunding. Platforms like Fundrise or Arrived Homes let you invest 0,000 into rental properties across the U.S. For example, a $500 investment in an Arrived property in Boise returned 9.2% annually over 2 years. Passive, hands-off income. Fourth, REITs, real estate investment trusts. Trade like stocks, pay dividends. Publicly traded REITs averaged 10.1% annual returns from 1990 to 2020. Pick one that fits your time, risk tolerance, and capital. No strategy is best, only what's best for you. You make money when you buy, not when you sell. That's the real estate mantra. Location determines cash flow, appreciation, and tenant quality. Look for markets with job growth, population increase, and affordable housing. For example, Fayetteville, NC, 50,000 buys a 4-bedroom rental pulling $300/month. Cash flow 0,000/month. Oklahoma City, median home price $60,000. Rent $900. Cash flow 0,000/month. Atlanta suburbs, Stockbridge, 0,000 home rents for $600. Cash flow 0,000/month. Avoid coastal hype like San Francisco or Miami if you're starting out. Median prices exceed M. Instead, focus on B or C neighborhoods in growing cities. Places like Dayton, Ohio, or Birmingham, Alabama, where you can buy a cash-flowing property for under $50,000. Use tools like Roofstock or Zillow's rent estimates to screen deals. Pro tip, aim for 1% rule. Your monthly rent should be at least 1% of the purchase price. A 0,0,000 property should rent for 0,000/month. Break that rule only if appreciation potential is strong. Cash is great, but leverage is how investors build empires. You don't need 0K to start. Here's how to buy with little or no money down. Option 1. FHA loan with house hacking. Buy a multi-unit property, live in it for 1 year, then rent it out. Your down payment? As low as 3.5%. Option 2. VA loan. If you're a veteran, you can buy with 0% down and no PMI. One investor in Texas bought a 80,000 duplex with 0 down, rented both units for $800 total, and now pulls 0/month in cash flow. Option 3. Seller financing. The seller acts as the bank. You agree on payments. They hold the deed until it's paid off. I know a beginner who bought a 80,000 house in Tennessee with 0,000 down, 7% interest, and 500 monthly payments. He rents it for $900,000/month profit from day one. Option 4. BRRR method. Buy, rehab, rent, refinance, repeat. Buy a fixer-upper below market, renovate, rent it, then refinance to pull your cash out and buy the next one. Leverage, not cash, is your launchpad. Most new investors fail, not because real estate is bad, but because they make preventable mistakes. Mistake number 1. Underestimating expenses. Newbies think rent minus mortgage equals profit. No, you've got property tax, insurance, maintenance, vacancy, property management, if used, and CapEx. Rule of thumb. Set aside 25 to 30% of rent for non-mortgage expenses. On a 0/month rental, that's 0,000 gone. Mistake number 2. Over-leveraging. Just because the bank offers you a 0,000 loan doesn't mean you should take it. One rate hike, one vacancy, and you're underwater. Keep a 6-month cash reserve. Mistake number 3. Skipping inspections. A 0/0 inspection could save you 0,000 in hidden roof or foundation issues. I know an investor who bought a deal in Detroit for $5,000, then found 0,000 in plumbing repairs. He lost $5,000 before the first tenant moved in. Lesson: slow down. Run the numbers. Hire a professional inspector. Use a real estate attorney. Success in real estate isn't about speed, it's about precision. Once you've got your first property, the game changes. Now it's about momentum. Use your cash flow to fund your next deal. Let's say your first rental nets 0/month. That's $200 a year. Save it, and in 2 years, you've got $4,400, enough for a 10% down payment on a $50,000 property. Then do it again. Better yet, refinance. If your property appreciates to $50,000 from 0,000 and you owe $80,000, you've got 0,000 in equity. Cash out refinance to pull 0K and use it to buy 2 more properties. One investor in Georgia did this with 5 homes, now owns 17 properties with 5,000/month in passive income. Want faster scaling? Partner with others. Bring the deal, they bring the cash. Split profits 50/50ths. Or use syndications to invest in apartment buildings. The key is consistency. 1 deal per year turns into 10 in a decade, each paying you every month. You've just learned how to start real estate investing from the ground up. No fluff, no hype. Now it's your turn. Pick one action. Check your credit, research a market, or calculate your first deal. Then go do it. If you found this helpful, smash that like button, subscribe, and hit the bell, because we're diving deeper next week into the BRRR method with a real deal breakdown. And in the comments, tell me, what's your number 1 question about starting in real estate? I'll answer as many as I can. Remember, every expert was once a beginner. Your first deal is the hardest. Make it happen.